Welcome to the Wealth Twins Show. In today's episode, which is episode number 13, we're going to discuss what type of mutual fund you should invest in to build wealth. And the quick answer is one that is passively managed, low in fees, and meets its objective. So let's unpack that statement. So maybe you don't know what exactly a mutual fund is. A mutual fund, if you want to think about it as a bundle of securities that is managed within one portfolio. So you can have stocks, bonds, different securities, and they're managed into one portfolio by professional money managers. And the money that is used to buy these securities are pulled from a bunch of different investors. So a lot of investors put their money in order to buy these securities. Now, when you purchase a mutual fund, you're actually purchasing shares into that mutual fund, okay? So that you can share in whatever the growth of that mutual fund is. Now, to make it less complicated, I think I have a good example that may help you understand this. It's not perfect, but if you think about Netflix, for example, you have the ability to buy movies on your own. But if you bought a bunch of movies on your own, it will cost you a lot of money, right? Now, if you want, you can buy Netflix. Now, if you have a subscription to Netflix, you can go onto Netflix and now you have access to all the movies that you want instead of having to buy that. That's similar to you buying shares of a mutual fund. Now you are part owner of that mutual fund, but now you get access to all the stocks or bonds in that mutual fund. I hope that makes it clear. What do you think, Nicole?
I think that's good. And if you want to bring it back to investing, let's say, for example, you can buy a mutual fund that actually is based off of the S&P 500. Now, you can either buy all the companies that are in the S&P 500 individually, which will be very expensive, or you can buy a mutual fund that mirrors the S&P 500, and just buying that one mutual fund, you have access to all the companies within the S&P 500. So if you want to bring it back to investing, I think that's the way to do it. Nadia, good job on a Netflix example, okay?
Well, go ahead. So you brought up index fund. Now, if you're
No,
going to
I
talk
actually
about
did not bring up the word index fund, and there's a
okay,
purpose reason I didn't. So
okay.
now, going, so that was a good idea, Nadia, with the whole Netflix. Now, when I gave the example, I actually did a little distinction that maybe some didn't catch. I actually talked about a specific type of mutual fund called an index fund.
Mm,
So I think we should go into more into what exactly is a mutual fund versus an index fund.
I agree.
Now, with that, we should go back to the first thing Nadia says when it comes to buying the mutual fund you should invest in our opinion, when it comes to this in order to build wealth, which is, she said, passively manage, right?
Passively managed.
Now, overall, mutual funds, let's call it a category, right? And within that category, you have actively managed mutual funds and you have passively managed mutual funds. When a mutual fund is passively managed, the name for that type of fund is called an index fund. Okay. An index fund does not have professional money managers actually buying and selling and individually picking all the companies that are going to go into that fund. It is an index fund. The goal of the index fund is to match or outperform a specific type of index. And the example I gave earlier, the index that I referenced was the S&P 500. So a mutual fund whose only job is to track the performance of the S&P 500 would be called an index fund.
I agree.
If there are actual money managers who are picking and selling, buying and selling individual companies, or it could be bonds, it could be stock, it could be different things that are considered securities inside a mutual fund. If someone's actively choosing what those securities are, that is actively managed. So those that are actively managed, you can consider that name to be mutual funds. So you have
Exactly.
mutual funds that are actively managed, index funds that are passively managed.
Now, every mutual fund has an objective, right? The objective is to try to make a profit, but you can have a collection of securities that are based on a similar premise. So, say you have a mutual fund that only invests in securities that are not related to companies that deal with any alcohol or tobacco or guns, right? You can have a mutual fund that is just made up of companies or stocks or bonds that are only focused on companies that are, I say, against global warming. So
It
there's
could be
different
political
objectives.
based too, you know?
hmm So there's different objectives, but the one that we were talking about before, passively managed, would be an index fund. And an index fund, that objective is to meet or beat the benchmark index?
Okay, now I know when we're talking about this, people might say, well, what are ETFs? Isn't that a type of fund or so? So, an ETF is an exchange traded fund, and they're very similar. And some people might even put them in the realm of mutual funds, but they're similar in the fact that they're similar to both mutual funds and index funds because they can be actively managed or passively managed. Now, what's the main difference between the mutual funds that we discussed earlier and an ETF, which is an exchange traded fund, is the fact that how you buy it. You buy it in the market like you would stock. So you're trading it through different during the trading hours of the stock market. That's one of the main differences when it comes to that. And also, the objectives can be just the same as you would for a mutual fund or an index fund.
So if I was looking at a mutual fund that I wanted to buy in order to build wealth, one of the things that we said you have to look at is fees, because you don't want to pay a bunch of fees, especially if the fund is not performing in the way that it's supposed to. Like it's not beating the actual objectives that's set out for it, right? And if you look at it, most actively managed funds do not they do not beat benchmarks, right? They don't beat the benchmarks of the index funds. So that's what we're saying. You want to look at funds that are passively managed, especially if you're a beginner, because there's so many funds to pick out there, and so many people have different objectives in those funds, and they're trying to beat the market where most of them fail. If you're a beginner and you're just learning and you want to have a safer portfolio, then index funds may be the way for you to go because they're passively managed, and their objective is just to stay the same as the market or possibly beat it.
Now, it's not guaranteed that even an index fund is going to do well, but you're taking out the factor of having some more human involvement in terms of buying and selling.
I
Now,
agree.
there have been mutual funds that have actually killed it in the market. Like one of the most famous would be the Magellan Fund,
Hmm.
where his name is slipping me right
Peter
now. What is it?
Lynch.
Peter Lynch. Peter Lynch, he ran the Magellan Fund, and with that, he totally dominated the market for years. But having a great manager is could be few and far between. And if someone is doing great for this year, it does not mean they're going to continue to be great 5 years or 10 years out. That's what the data suggests. But you never know.
I agree.
Maybe there's a famous line in stock market, right? Past performance do not dictate future performance, right?
That's called a
But the data
CYA
says
term.
yes, but yeah, CYA. So Nadia will let you know what CYA is anyway. But that right there just tells you, based on the data that we do have, it is very hard for an actively managed fund to outbeat an index or its benchmark. So with that, this is why we say you want to do passively managed, low fees, and one that meets or beats its objective.
Hmm.
Now, when it comes to low fees, another reason why we say look at low fees is because fees work against your return you're getting on your investment. Think of fees as it is. It's a fee, right? They're going to take money away from you. So whatever money you make, even if your investments aren't making money, the fee is still in effect, okay? So you're
Exactly.
going to be paying some type of fee, and the lower you can make that fee, the better it is for you and the money you want to make on your investment. So overall long term, we want to make as much money as possible and grow as money as much as we can. So with that, we want to do as much as we can in terms of taxes and in terms of fees to try to lower the amount of money that we have to give away that's going to take away from the performance. Now, overall, if you really want to get into which funds that you should pick, then you have to follow another three things. That's your risk tolerance, your timeline, and your overall goals. Because as Nadia mentioned before, there's tons of different mutual funds, index funds you can buy out there, but how do you start separating them? That's an individual basis and what you're looking for. You got growth ones, you got value ones, you got ones that follow, specific types of companies. There's so many out there. You have to decide on what your risk tolerance is, what your timeline is, and what your goal is.
Yeah, just to speak on that further, if you're looking at different mutual funds or index funds, depending on your age, you wouldn't go to a fund that only invests in high risk stocks if you're closer to retirement, right? And if you are younger, you wouldn't go to a fund that only primarily invests in safe bonds, right? You want to be able to take advantage of the time you have in your side because you are younger and you can ride out the wave if there's volatility in your investment. So you want to go towards more aggressive securities. But if you're closer to the retirement age, you want to start investing in things that are safer for you so that you're able to maintain the amount of money you have invested and you know you're keeping that safe. You're not necessarily looking for growth, you're looking for more you're investing more for safety purposes at that point. So those are two different objectives. So depending on the person, there are funds available for you. You just have to know what kind of person you are, what your risk tolerance is, and how much time you have in the market, and whether or not you can stomach the ups and downs. Maybe you are an older person, but you're saying, look, I'm investing for future generations of my family so I can take on a higher risk. That's a whole different objective. But you got to look at who you are, and then that will determine what type of index fund you should be investing your money in.
Yeah, I totally agree with that. So with that, Nani, I think you were using words like volatility. We use words like index fund,
I'm
mutual fund,
sorry.
right? Because of that, I think it's a good idea for anyone that these terms are unfamiliar with or might seem a little difficult. When it comes to the stock market, Nadi and I both know that one of the hardest things to get over is the terminology. And
Yeah.
because of that, we have a little free download that you can actually download. It's called the 25 must know investing terms that you can quickly download. And that link will be in the description. So you download that, at
Exactly.
least will give you at least 25 of the most common investment terms that will give you a better idea. Whenever a word confuses you, you can just look at that document and hopefully it will help you out.
Yeah, we put together that simple download because being intimidated by the words that are used within investing should not stop you from investing, right? That is something that you can easily overcome. Now, getting over the fear of losing money in the market, that's a more personal type of thing for you to get over, but not being an educator or not knowing what words mean should not be a barrier for you for investing your money. So that's one of the things that Nicole and I have put together for you guys because we know it's something that prevents people from taking the step and moving into the market, especially when we know that time is the most important thing that you have on your side when it comes to investing.
Yeah. And I think anyone listening to this video is all about financial literacy and also they want to invest for a good reason. So,
Hmm.
with that, I hope this video helped you. If you like this type of info, please like this video, subscribe to the channel,
Yep.
and share it with someone you care about. All right.
And check out our playlist when it comes to ETFs, index funds, mutual funds. We have a lot out there. So make sure you look at those videos. And then I think you'll be pleasantly surprised at how much you will learn just by watching those. Talk to you soon, and we'll see you in the next video.